as an income fund manager, it's been a very difficult year. There's no doubt about that. With the FTSE 100, cutting its dividend payout by over 40%, it's been an absolute watershed moment. So, as we move forward in the next sort of year or two, what really is important is dividend cover, and companies not paying out unsustainable dividends is just so important. These companies need to be reinvesting back into the business right now, not giving us back dividends if it's unsustainable. So keeping that in mind when looking at the earnings that you just sort of talked about, Shell this morning, as I sort of dove into the financial statements of the quarterly report this morning, it's really pleasing to see how they've managed to flex the business and generate a lot of cash this quarter and actually pay the dividend based on the cash they've generated. So that's really positive. BP surprised us earlier this week, also showing its ability to flex the business and still generate a lot of cash. And so, that's a really positive outcome from them dealing with this particularly difficult environment. But with big oil, what is the question? What is the demand for their products going to be in a decade? And in terms of investing in them for the longer term, from my perspective, I invest in income based on a total return objective. And so what I can't put an easy figure on right now is the terminal value of the big oil companies as they switch and as society switches to a more renewable future. There is definitely going to be no doubt that they will have a part to play, but what part is we're still waiting to find out how the companies reinvent themselves. And as we're seeing right now, Shell and BP are starting to release very strong strategic messages about where they're heading in the future.